Hey gang, over the past few weeks, I've been showing you some of my favorite market timing tools. These are the same tools that helped me predict that the pre-election meltdown was simply a pullback and nothing more. In today's video, I'm going to tie everything together for you and show you how I use the same indicators to pocket over 20% in a single session. Over the past few weeks, in anticipation of the midterms, the market has been pulling back. It's been really getting kind of nasty. And I've been walking you step by step and showing you market internals and market indicators that predicted or anticipated that this bloodbath that we were seeing was merely a pullback and the market was going to go back up. And I even explained when was a good time to enter. And I want to review this right now so you can learn from this and gain some benefit, because believe it or not, this is very simple but very powerful. This is the VIX index. What the VIX index does is track option sellers and option buyers in the S&P options. It gives us the fear level that's in the options. Usually when we go above 20 on the VIX, we see that the market is in a danger zone. In this case, as you could see, we went to 25 while the markets were really pulling back and trading below the 200-day moving average, but the VIX didn't really react. It peaked out around 25. It didn't go further like we saw here or other times. So what this told me was that option traders were not fearful that the markets were really going to drop much further. Option traders, S&P option traders, have very good insight of market action, and they have very good insight of market sentiment. And when I saw the VIX peak out at about 25 and didn't go any higher, I knew that global tension wasn't nearly as high as the markets were expressing in their price, and this was merely a pullback. That was one of the factors that I looked at. The second factor that I looked at was the put to call ratio. And what the put to call ratio does is tell us whether markets are overbought or oversold. It gives us a ratio of put buying to put selling. And when one gets out of whack with the other, it's telling us markets are overdone. Usually when we see put to call ratio above 110, it's telling us selling pressure is over and buyers are about to come in. In this case, we went all the way to about the 130. As you see here, we edged all the way higher. We went to about 130. This was not easy for the market to do, but it didn't go any higher. And it kept backing off. Each time it swung up, it backed off. And that told me that the selling pressure was near its turning point, and we were about to see some upside leading into the election or right after the election. Just to be on the safe side, I went over the 200-day moving average, and I explained a few times that we never ever want to go long till the stock market is above the 200-day moving average. This is where the bears are, and this is where the bulls are. If you're above the 200-day moving average, you're on the bullish side of the market. And if you're below the 200-day moving average, you're on the bearish side of the market. And I specifically asked you to wait till we get above the 200-day moving average to go long. And as you could see here, right after the election's over, yesterday we opened right above and we continued moving higher the entire day. I wanted to tell you something very important. Analysis for the sake of analysis is useless. It's all about taking action. And in fact, we did just that. On the 7th of November, we issued an alert on the SPY option. Every member of my Precision Profit program got advance notice of this alert. I sent it out in the morning time, and everyone who entered the trade had a potential to make over 20% gain in one trading session. Right now, I'm giving a few more subscribers access to Precision Profits. Click the button below to learn how to join immediately, and you'll begin receiving alerts just like the one we talked about today.